Oh,
Let's go. Cool, easy. All right. Well, thanks, Tim. For anyone joining for the first time today, I'm Josh, CEO of SuperGuardian, and feels like in reality I'm actually joining Tim's show because he does these every month. For those of you who are long time fans, you know the drill. So Tim presents these webinars every month. And I just before we jumped on this one, I actually checked our list of webinars that are all past webinars online. I think this is officially webinar number 77.
wow.
So been doing this for a while. I was sort of hoping it would be like an exciting number like 50 or 100 or something like that, but 77 is still a very good number. So appreciate that. Um, Lots of things to talk about today, especially coming up to the end of the financial year. Lots of different conversations that we have during the year with advisors and that have evolved as legislation has emerged and budgets have been announced and all of those sorts of things. So plenty of things to talk about. As I'm sure Tim would normally say, don't hesitate to put any particular areas of interest or questions in the question box there. We'll try and get to as many as we can. But I guess we don't often, well, I don't often join these webinars, so it's worth just giving a quick rundown about SuperGuardian for those of you who are new to this. Our core focus is obviously SMSF admin, keeping information up to date and reliable, and then making sure that you've got the support of our team of client managers who are all in some way, I think, students of Tim's over the years. So when you hear content like this in a forum like this from Tim, just know that we've also got a team of people that Tim has trained very well over the years that are your primary points of contact when you work with us. That's probably a fair enough introduction from me, but
Yep.
yeah, maybe I guess we're at a point now where and there's been plenty of conversations and plenty of webinars on the Division 296 tax changes. And over the past few years, we've sort of gone from this many conversations with advisors and clients around intergenerational wealth transfers, potentially taking money out of super, especially over the $10 million threshold. And that continues to, be true and relevant. But we've also more recently had the budget changes, which has stimulated some more interest from younger cohorts of prospective SMSF trustees. And so, no doubt, as advisors and professionals, you were having a range of different conversations with different clients around that, and hopefully, in this forum, we can give you some pointers, some next steps, some things to look out for that you can take to those client conversations, whether or not they're the clients at the point where they just want action, or whether or not they need a conversation around building trust in the system. I'm not sure that we can necessarily help in that respect, but we certainly appreciate the types of conversations that you're having and hope that in some way a forum like this can help build your skills.
Yeah, look, and it's great. And so Josh and I try to do this at least once a year, get
Yeah.
together as around that sort of checklist 30 June kind of concept. And it covers off on a couple of things really for us. It's one, the link between having the appropriate education, but then how that flows into fund administration and compliance, because clearly that's what we're actually all about is ensuring that all of our clients comply from an SMSF point of view. So it's good to get a different perspective on things, not just the guy rambling on for CPD points. It's actually making it real and bringing it back to the client realities is a key thing. But it's also an opportunity to act as a bit of a reminder, because we get into that flurry of 30 June. As I said to Josh as we were preparing for this, 30 June's just a date for me because I don't have to worry so much about lodgements and other things. But for the start of my career when I was all in admin and I was all about pensions and things, 30 June was so critical. And so it remains critical from a client facing point of view because there's deadlines. There's deadlines for pensions. We'll touch on a few of those elements today. There's deadlines for contributions and the ramifications of getting it wrong. And today is not about focusing on getting it wrong. It's about ensuring that we don't, and making sure that our clients cover off on the key thing. But then you have a year
And
like
what do we
this.
need to do and when?
Yeah, that's
Yeah.
right. But then you get a year like this where we're also seeing the introduction of something new, and many of us are having conversations in light of the budget, but the Div 296 horse is bolted, right? So it's there and it's starting in 3 weeks, 4 weeks, whatever the date is, and so we shouldn't be jumping at shadows because of the budget. We should be planning based on what we know. And so when we're talking to these clients that are going to be impacted by Div 296, there are things that we might want to act on now, and Josh and I will talk about CGT in a moment, but there's other elements where we've still got time. So, one thing about super is with these impacted clients, if they rush to pull their money out because of the fear of what the budget delivered, they're not getting that money back in, right? So that's a real area of concern that people need to be well informed to make sure they make the right decisions with what they do with their money purely from a taxation point of view, clearly.
Yeah, and that's where it sort of comes back to the level of trust in the system. I think it goes through phases, right?
Yeah.
We had so many different or quite a lot of time elapsed between when the proposed Div 296 changes were announced and actually legislated, and through that phase, we sort of there was uncertainty, and it wasn't until it was legislated and we had more confidence, more clarity that people actually then start to build trust and then make decisions. And many conversations we were having with advisors around the time around taking money out. And is it worth taking money out if you've only got 3 million or 3.5 million and all of these sorts of things. But there's so many broader considerations, especially when we now are in a position of sort of, distrust again as we wait for new non-super legislation to be passed and understand what we're working with out there. But it just highlights the importance of making informed decisions and considering the future before you just jump in and make decisions without thinking about that.
100%. And I can tell you with 100% certainty, I've never been busier in a non-super budget than I have this year.
Exactly right.
I mean, only two budgets have ever really tested the limits, 2017 and 2007 or 06 and 16. But this one was pretty crazy for everything it didn't have, which obviously ultimately will impact the super space. But
it's the budget of the decade, isn't it? Every 10 years, I think you've highlighted that.
Yeah. And for those that joined us last month, you can go back and have a look at that on the SuperGuardian website as well. But I started to talk about the forecasting and the concepts from the budget and how they will be impacted with Div 296. And so we don't want to rehash that, but I also highlighted that one of the things I definitely wanted to touch on today was this Division 296 and the CGT piece. And again, in preparation, Josh, you and I have spoken a little bit about the concept of what clients should be doing, and we do know that it is, as I state here, it's a one-off opportunity. So it's something that we have to be thinking about. We don't have to act on it yet, right? So this is one of the key points that people need to be mindful of. If people are going to for Div 296 purposes, reset the cost base, they don't have to make an election until the lodgement date at the latest for the 26-27 year. They can clearly make an election whenever they want to. There is no form to make an election on at the moment. Let's be clear about that. The tax office are scrambling like the rest of us to get up to date with a lot of these sorts of things. So, there's time to act on the decision to reset, but it raises a question that I know, Josh, you've been getting a fair bit of, and we have too, when it comes to the concept of capital losses.
And what do we do? Yeah, so there's clearly actions that need to occur after 30th of June 2026.
Yep.
There are some actions that could occur prior to that in the next couple of weeks. But interestingly, just with our approach to the CGT cost-based reset and documenting that and determining which clients it applies to, just for some clarity, it is our intention to have that form part of the 2026 financial year-end returns. But again, it depends on whether or not we've got the prescribed form from the ATO, and clarity around exactly how we report that. So we're sort of waiting on that, but it is our plan to roll it out over the course of the next 12 months as we finalise those returns. Noting, however, that the deadline is actually not for the lodgement date of this coming 26 return. It's actually the 26-27 return the following year. So there is time in that respect. There's perhaps less time in respect of what can we do between now and 30th of June 2026. And it's worth just diving straight into this sort of concept of realising losses, because it's one that has come up quite a number of times. And I'll describe it as that there's two opposite perspectives on this, and both extreme perspectives, and we need to understand what the reality is. One perspective says, realise as many assets in a loss position before 30th of June 2026 as you can, because that will be a benefit. The other perspective says it doesn't make a difference whether you realise those assets in a loss position or not. And so just to provide some clarity around that. So if you have a portfolio that is in a net gain position at 30th of June, across the total portfolio, there is really no benefit to realising losses before 30th of June, unless you're selling down assets between now and then, and you're selling down assets in a gain position, and that then means that by 30th of June you're in a net loss position, and you therefore wouldn't elect the cost-based reset. Where there may be benefit, and to be clear, from a tax perspective, there's no real downside to realising assets in a loss position now, because they're either offset against other gains in the current year or carried forward. So there's no real downside to that. The potential upside is if your client portfolio is in a net loss position at the present, when you add up all of the gains and losses across the portfolio, but close to being in a net gain position, if you were to realise those losses between now and 30th of June and move the fund in the portfolio into a net gain position, and as a result, there is value in then electing the CGT reset, that's where it can be beneficial. So hopefully that just helps to clarify. It's quite a unique, specific scenario. For most clients, it'll be pretty straightforward when we get to the point of saying it's a yes or a no. There's a pretty unique scenario there where realising losses before 30th of June can actually be beneficial.
And I think the point that I get across in this regard is, I will ultimately be taking my hat off to the administrators when it comes time to it, because you're going to be effectively preparing two sets of returns, in the sense that you're going to be doing your earnings base for the fund point of view, where your losses are exclusively about the tax of the fund position and the net capital gain position there. And then you're going to be doing your Div 296 earnings calculations, which is going to be on all earnings attributable to transactions post the 1st of July 2026. And so that moves us forward. So you clearly want to get your position from a fund point of view at the highest point from a CGT position to minimise any potential future gain from a realisation point of view with Div 296. And of course, that is a how long's a piece of string question, particularly for those clients who may not currently be in Div 296 territory, because you don't know that they're ever going to be in it. Right. And there's so many ramifications and contemplations around estate planning and other things to factor in. And so, I mean, for any fund in a gain position at 30 June, there is nothing lost by making the CGT election, because it's only for Div 296 purposes. It doesn't reset anything from a pure fund tax point of view. And so for those that are in the gain position, make the election. That's kind of you don't lose out by making an election there. For those in the loss, you've got to think that through, and you've got to work out what's ultimately going to be best. And that's ultimately what we provided for with the content here, in the context of it is a 30 June decision. You don't have to make it by 30 June, but if you want to act from a losses point of view, you've definitely got to do something before the 30th of June.
Yeah, yeah, and just know that for all your clients with SuperGuardian, that our client managers will engage with you around this. So you'll be supported and informed through that process as we work through it. Not just for the clients that are over $3 million already, but also potentially where it might benefit other clients who are approaching that, or could be over 3 million with a death benefit or insurance policy, or there's a number of different scenarios. But we'll support you through that as we go through the year-end finalisation process in the year ahead.
Yep. And look, I guess the last point I want to make on this, made it last month, made it when Div 296 first came out in Feb. The key bit being that it's an all or nothing approach too,
Yep.
right? So you can't be selective, which is why we're focusing on the loss piece here, is that we've got to say, well, we've got to make an all of portfolio decision around what we're going to do, understanding the complexities, which we don't necessarily have the time for today to go through on unit trusts and other assets where there's an asset held inside of that. You've got to be mindful of that. But also, I know that one of the interesting things that Josh for me has been around since day one, which for me was 1999, is the single line asset approach, and I think that's something that people need to be mindful of, is that that's an ease of administration thing, but it creates a lot of complexities if people try to go down that path when you're doing such things as these CGT resets.
Yeah, I mean, and it's something that we are happy to support with if you have clients that typically have their financial statements report a one line wrap portfolio or something like that. It was 14 years ago now. We unwrapped every single portfolio on our system, and so we do go to the underlying assets. We're very familiar with reconciling those on a regular basis as well. So more than happy to support in that space if you've got clients that need help with unwrapping.
So look, that's CGT. Hopefully, a lot of you have got decisions ahead of you to make. I think when I say hopefully, you'll have decisions ahead of you to make. I think everyone in the SMSF space does in that regard. Total super balance is one that, there's not a lot we can do about it necessarily. It's clearly a transactional number based on our balance at the end of the year. But I think the reason I like to highlight it from a checklist point of view is people are making decisions now about, should I contribute to my fund? In the final weeks of the financial year, and ultimately it results based on what you had last year. Where was your balance sitting at 30 June last year? Were you less than 500,000? Can you carry forward amounts? Have you gone into MyGov to check that information out? All these sorts of things become relevant, but importantly, and probably for me the best change. And when I say the best, the only great change or introduction from Div 296 from a legislative point of view was the simplification of total super balance. So we removed this unnecessary, maybe it was necessary because of how it was introduced, this unnecessary link back to the transfer balance cap for a modified pension amounts versus balances versus the concept of withdrawal value. And I think this is a real positive measure which is in place for 30 June this year, that our total super balance represents our withdrawal value as at the 30th of June for 99.9% of self-managed super funds. So there's still a very small fragment of funds that have defined benefit pensions. Okay, there's issues to contemplate there as to what the total super balance is, but for the vast majority, it's if I took my money out on this day, what would my value be? And that's our total super balance. And it's important from a strategic point of view to understand it for contributions this year. But it's also, I think, important to look at it to go, okay, well, the general transfer balance cap is indexing to $2.1 million from the 1st of July, which means our contributions next year are going to be based on this coming total super balance, right? And so when we're looking at the increase in non-concessional caps from 120 to 130, the increase, obviously in concessional to 32.5, strategically, where are we sitting from a balance point of view? Has our portfolio performed so well this year that we might actually jump well above the forecast general transfer balance cap of 2.1, but last year our balance was lower, and so we need to actually maximize non-concessionals then, because we might not be able to do it next year. So it's one of those areas where strategically understanding how total super balance works and knowing your review points being 30 June make it pretty critical for the decision around your ability to contribute. Because the last thing you want is clients who go, well, the non-concessional cap's jumping up to 130. I'm going to wait till the 1st of July, but investment performance. I mean, yes, they get the wriggle room of the general transfer balance cap going up, but investment performance, if that's outperformed the CPI, the general transfer balance cap, then you're not going to get that opportunity to contribute. And so this year might be the year. And so you want to look backwards to make decisions about moving forwards.
Yeah.
And that's pretty important.
And interestingly, I mean, of course, we don't want to have to look too far backwards. So we want to get to July, and this really is our processing model. Is that by the time we get to July, we will already have a very high degree of confidence in the 30th of June values, that then govern what the total super balance looks like for each client, how much they can contribute, etc. So, and just one thing to note on that is obviously, we go through and we reconcile all of our clients on at least a monthly basis, and so in July you can have confidence in the 30th of June value. The only thing to really look out for there is where there's unlisted investments or things like that, where a market value isn't determined until a month or more later sometimes. So just keep an eye on those sorts of things. But we identify those, and we proactively work to make sure that you can rely on that value as quickly as possible after the end of the financial year.
Yeah, and from the regulatory point of view, I was happy to update this slide, for example, Josh, only because the ATO, again, so much going on with payday super with DIB 296, but the regulatory return, the 26 return, is updated to reflect the new definition. So it's removed the old references to adjusted total super balance, where you could go in and change it based on the retirement phase value and the accumulation phase value. The actual terminology has been updated to this withdrawal value, which I think is positive. And that is that, most of the systems out there will calculate the total super balance based on standard accounting practices. But because it is withdrawal value, you can manually make adjustments. And those adjustments have to be linked to potentially and most likely to your property-based transactions and other things that are going to significantly impact a fund position. But also the one thing, and I think we had this conversation last year, I certainly had it with more people. I was quite staggered at the number of people within the fund from an industry point of view that don't engage in tax effective accounting. Because I've being around for so long, it's always been one of those, should you, shouldn't you? And it kind of always served different purposes, and where it was ineffective was people wanted to withdraw more money, and so by they wanted to remove any sort of tax provisions for calculating minimums and maximums, and so it kind of became the norm to not do tax effective accounting, whereas the concept of total super balance at least brought it back to front of mind as to what's the potential tax impost of having to sell down all these investments, and will that significantly change the total super balance?
Yeah, as soon as you end up in a situation where people are working to a threshold, and they're just slightly above or below, and there's a strategic opportunity in being on one side of that threshold or another, all of a sudden, it's very easy to become creative about what opportunities do we have to bring in selling costs and those sorts of things. So always happy to have a conversation around that.
Yeah, and I think as one of the concepts that we'll talk about today briefly is ECPI. I'm kind of the school of thought when it comes to things like tax effective accounting, when it comes to segregation versus non-segregation. I'm not a kind of a crisscross jump around kind of person. It's to me, you pick a strategy and you roll with it, and that's how you report on all of your funds or whatever, so that there's consistency and you're not chasing maybe a minor tax benefit. I mean, it's as I said, it's around the edges that you've got to be careful, because you don't want to be caught up in a situation of why did you do that year and not every other year to obtain this particular benefit from an ATO point of view. So let's have a look at contributions, because clearly this is one of those great little periods of time where we get indexation synergy, right? So
Mm.
we've got the concessional cap, the non-concessional cap, the transfer balance cap, everything going up, which gives us that little bit of space to work with. We get the changes, which they're not SMSF changes by any means, but payday super changes the SG landscape around things like maximum contribution base moving to an annual threshold rather than a
Mm.
quarterly threshold. I was in a random conversation with a totally non-superannuation person the other day, and they said to the other party, "Oh, from the 1st of July that my employer has to start paying my super with each of my pay." And I almost fell off my chair. I
Yeah.
went, "Well," I said,
There's some awareness around this
so,
beyond the super
and
insurance.
this was a 22-year-old, 23-year-old. So they're the same age as my son. I thought, there's no way my son has that knowledge. I shouldn't say that because he did work here at SuperGuardian. He was a valued employee for a little bit
Very
of time,
knowledgeable.
wasn't he?
Very.
But I thought it was fascinating that superannuation used to be, a whisper conversation,
Yeah.
but it is certainly far more front of mind now. And I think that was fascinating to be involved in that conversation and not
Yeah.
to lead that conversation.
Yeah, I think, and young people these days are very well aware of when their employer has to make their payments, and a lot more, I think, engaged than young people when I was a young person once upon a time.
Still a young person
Um,
there, Josh.
so yeah, I think they're a lot more engaged around their financial futures, and that's evolved over the last 5 or 6 years, I reckon. Even
Yeah.
through COVID, with a lot of online resources. And social media and things, and there's pros and cons to a lot of that information that they get, but they are more engaged and they're
Yeah.
more interested, actually, I think,
Yeah.
generally.
And so I think a lot of that, and for all of those that have attended these webinars with me before, and anytime I talk about contributions, you've seen this slide, right? This contribution strategy
Mm,
slide. I created it many years ago, and it's not rocket science. It really highlights for us the various strategies, but we're at that time of year now
mm,
where we're going, okay, what opportunities do we have? Are
mm.
we looking at contributions from a deductibility point of view and offsetting our tax? Are we looking at from um, an investment point of view and an opportunity to either contribute shares maybe into the fund, and is that something that we're going to see over the
Yeah,
ensuing period with moving assets from the family trust to super?
yeah,
That's definitely a conversation for another time,
yeah.
but a conversation that's going to be had. But it's also, excuse me, in light of things like payday super, an opportunity to review things like salary sacrifice contribution
Mm,
strategies and that moving forward and other
mm,
opportunities. So it's about maintaining contribution relevance from a strategic point of view.
yep.
I don't know if you got something just while I have some water there,
No,
Josh.
no, knowing what's there and what's available, I actually, I have a dream. It's only
Yeah,
a dream at the moment, but a dream of actually just making all of these sort of opportunities pop in Hive. We've got a lot of work that we're doing in Hive. For those of you who are on Hive, contributions is one area that and strategies around that is one area I would like to do more
yeah,
in. Our focus has been more around compliance. The $3 million balance, pension minimums, and those sorts of things, which we'll get to shortly.
yeah. And look, and I think it's important to identify the various strategies because, and one of the things that I do talk about in my contribution webinars is the contribution matrix around who should be using what sort of strategies,
Mm,
spouse contributions, rebalancing, and those sorts of things. In light of Div 296, rebalancing is going to be for some people critical, right?
mm,
To get people under the threshold. But in an estate planning point of view, rebalancing might not be beneficial if there's blended family
mm,
situations and all of a sudden money's moving from one family to another family in a technical sense. And estate planning is still the big sleeper for Division 296,
mm,
right? And so it's the area that will become central to people's focus when looking at what their opportunities are. And so a lot of that is driven by contribution strategies. And back to your comment earlier, Josh, but also the stuff from the last webinar that I did around the potential budget changes with
mm,
family trusts and CGT and things. We know that for clients with more than $3 million, they can't make non-concessional, but they can still make CGT cap amounts
mm,
for sale of small business assets or whatever, and they can still make downsized contributions. And people will go, well, these sizable contributions, will they be problematic in a Div 296 environment? And I
mm,
think that's that analysis that people need to consider is, well, it might make them liable for Div 296, but if that money's sitting outside of super, what's their tax liability in
Yeah.
that environment? And that's the area that we have to learn how to focus on
Mm.
in the more broader
Yeah,
conversations with clients.
it's all relative, isn't it?
Yeah,
And we're in a situation where we're talking about potential minimum 30% tax rate
yeah,
in a trust environment, and technically a 30% maximum rate if you're under 10 million.
yeah,
15% if you're under 3 million, 0% if you're in pension phase for the assets in pension phase.
yeah,
So we're sort of talking 30% minimum tax out there versus 30% maximum in
yeah,
here.
yeah.
And all of a sudden, super becomes a whole heap more relevant, especially where you're on a lower tax rate in the super fund.
Yeah, yeah. And so, the reality is that whilst we're focusing on things we've got to get done by 30 June, we're also focusing on things we should be looking at as we move forward
Yeah.
from a strategic point of view. And then again, that's the conversation I had before around the general transfer balance cap increasing. Wow, it's exciting. We get to put in 390 versus 360,
Mm,
but in chasing 390, do we miss
mm,
anything? Do we
mm,
miss everything?
mm.
So are we better off putting money in this year based on last year's
Yep.
versus chasing that additional 30,000 that we might miss out on because our portfolio has performed well,
Yeah.
and
Yeah.
and I think they're key issues.
And this is the time of year where the next couple of weeks could make the difference between whether or not your client has 2.15 million
Yeah,
in their member balance compared to 2.09 million,
yeah,
and the difference between whether or not they can contribute the additional 130,000 or not. So a small difference for some clients can make or can have a big impact in terms of contribution caps. And so the closer we get to 30th of June, the more confidence we have in what the closing account balance is going to be, markets sort of
yeah,
aside. But you might have a client who's over 2.1, they're 2.15 at the moment. They could potentially withdraw 51,000, come under the 2.1, probably a little bit extra
yeah,
just in case, especially with market movements and things like that. But they could potentially, if they're eligible to withdraw from the fund, to free up an ability to contribute a larger amount in the new year. Or for example, if they're 1.85, then potentially they could draw more than
yeah,
$10,000 and free up $390,000 of bring forward, providing they haven't already
yeah,
utilised that in the past 3 years. So there's some really unique strategies that can work for clients around this time, but
yeah.
it relies on getting it right, and it relies on having up-to-date information that can give you the confidence to make those decisions, and not end up in a situation where you're providing advice to clients with bad information that then costs them a lot of money in the long run.
Yeah. And look, I'm not a betting man, Josh, but one thing I can almost guarantee is, well, I can't guarantee anything, but market value is going to be scrutinized this year.
Mm.
I mean, when we're looking at
Yep.
CGT reset or whatever, and
Yeah.
it's been a hot topic for auditors since transfer balance cap came in
Mm.
ultimately. But if there's going to be a year that people are going to be looking closely at the valuations that you're adopting at 30 June,
Mm.
it's going to be 30 June 2026, from a numbers point. So people need to be mindful of that. And the flow on between the conversation and the more broader estate planning piece is the effectively the work back. And the work back, I like to call it the work back because we got our terrific rule from 2022 of the relaxing of contribution rules up until effectively age
Mm.
75 with no work test. And so, and the beauty, and I think the unexpected beauty of that change was the ability to use the bring forward in your 75th year. So as long
Mm.
as you're under 75 on the 1st of July, your capacity to put in the full bring forward amount that year. And it really changes the contribution landscape, and it changes the estate planning landscape. So if you walk away from Div 296 for a moment and you look closer at most other clients who are not in Div 296 territory,
Mm.
but let's say those clients with around that $2 million mark, the recontribution strategy using non-concessional becomes pretty significant, because if you've got the ability in June to withdraw, let's call it the maximum NCC for the next year, and it brings you down below that 1.84 threshold. And then you also got the capacity to commence income streams, then you can start to create this balance of tax-free versus taxable components. And that's where it's going to be critical in the greater analysis of Div 296 with reference to that second death benefit, where money goes to seconds or to spouse on death. No taxing point there, but potentially triggers Div 296 for that second spouse. Then you weigh up the benefit to go, well, okay, we can accept that. But then, and we've spoken about this before, the three layers of death tax that aren't called death tax, but they exist now, and that is tax on the sale of assets inside the fund, so anywhere between 0 and 15%. Then you've got tax to the non-beneficiary, right? So the PAYG onto to non-beneficiary on the taxable component, and that's going to happen in death benefit number 2. And then you got Div 296. And so you have to look at which of those taxes can you eradicate, right? And if you've got more than $3 million, you can't eradicate Div 296 without taking money out and potentially creating a tax liability elsewhere. But subject to when you start a pension, you can eradicate a lot of the 0 to 15. You can bring it closer to zero by being more in pension phase and accumulation up to your cap. And by using recontributions, you can offset some of that PAYG piece. So you can actually strategically work your way through some of these to minimize that death tax that doesn't exist.
Recontribution strategies, I'd say, have never been more relevant. That there is obviously the benefit of the increasing or reducing your taxable component in the fund, increasing the tax-free component, but also rebalancing in light of transfer balance cap and now Div 296. There's never been a better reason to give that some serious thought.
Now this one, Josh, this is it's a bit of a administrator's nightmare conceptually because of the rules associated with it. And this is where I've always found this one interesting, is that the commissioner, we like to think of the commissioner occasionally as this, I don't want to use the word bully, but effectively they're administering the legislation in front of them that in most instances, particularly in tax world, gives them very little discretion. And in things like personal deductible contributions, it ultimately gives them zero discretion, right? There are rules around when you must lodge your notice, right? When you must provide your notice, and there are rules around when you must get your contribution into the fund to be eligible for being able to claim a personal tax deduction. And so it's critical that people understand the timing of their notice of intention, particularly as we enter 30 June, because what people will do now is they'll sit down and they'll talk to their personal accountant, and it's like, well, let's review that. Once the year's over, let's review that with a vision of what your income is. But the same person wants to start a pension on the 1st of July, right? If they want to start a pension on the 1st of July, then they've got to do their notice of intention before the 30th of June, right? Before they commence that pension. And it's not just pension commencements that can trigger notice considerations as well. Notice as well.
It's really critical to get this right, because it's, as an advisor, when you're talking about making contributions and especially tax deductible contributions with your clients, you want to make sure that if your advice is to make that contribution, that they're actually eligible to claim it as a tax deduction, for example, and not create a whole heap of excess contribution, non-concessional contribution issues aside from the not benefiting from the tax deduction. And it's actually a common thing that we hear from advisors around where advice goes wrong. So this is not a sort of pie in the sky issue. It's a real issue that advisors come across on a regular basis. But this actually is a really key part of it, is the timing of the submission of this election notice. And it's not just prior to commencing a pension, for example, but if you're rolling over money between funds. So let's say you're recommending that a client set up an SMSF or transfer money from an industry fund or a retail fund into an SMSF, and they've made a contribution in the year prior to the rollover being processed. double check, triple check that they've submitted the notice of intent, because if they haven't by the time that rollovers is processed, there's no going back, and there's just no solution to that. So it is really critical to make sure you get it right, and your clients check it and you check it as well.
And look, a point that I've added to this slide is one that I saw in practice recently from a conversation I had with a colleague of mine, and I was happy to see. Happy is not the right word, but the tax office have made a very important update on their website. So let's say that Josh, you've got your contribution, and you make a personal contribution that you're going to claim a tax deduction for, and you're under your concessional cap, right? But you put in $25,000.50, right? Just because you had, I don't know, you had to lose 50 cents around, but whatever, but there's cents attached to it, right? Then you've sat down with your advisor, right? And you have put in $120,000 this year, right? And the goal is, because you're under the 1.84 million, then next year you're putting in 390, and you do that in July. So you put in 120 in June, you put in 390 in July, right? And then you go and claim a tax deduction for $25,000.50. The tax office are going to give you a deduction for $25,000, right? It is a whole dollar amount. So they've updated their website on this, and it's an issue that those cents will count towards your non-concessional. So if you put in your 120, well, your non-concessional contribution is $120,000.50, which means you've triggered your bring forward amount. Now, as minimal as that might sound, you've just created a nightmare, right? A nightmare for the fund from a bring forward point of view, from an excess non-concessional. And we know that the associated earnings is not taxed as terribly as it once was, right? Or the excess non-concessional, but you've created a nightmare that you cannot fix by refunding that contribution next year. So understand that cents matter.
So is what you're telling us that we should rather put in 119,999
and 50 cents
just as a precaution?
Yeah, exactly. 99, and then the cents don't matter. But it is certainly an area that you just don't want to be
doesn't
caught
make
up.
sense, to be honest.
No, exactly. It makes no sense. But I saw it in practice, and
it does
and the client gets a notice. So I'm glad the ATO put that on there. It's just annoying that they had to put that on there, right? And that they can't just go, what's a dollar? But give them $1, they'll take 100. That's how it works. So the notice of
plenty
intention,
of puns we could add in here.
Indeed. So the notice of intention piece is critical for us to be mindful of, but also as we approach 30 June, the fact that the contribution's got to be in the fund by the 30th of June too. That's a critical one that people need to be mindful of. On to my favourite topic of this time of year, and I guess it comes, I'm a pension administrator at heart. Administered way too many pensions in my time, that you kind of get used to head down at 30 June, making sure your clients are meeting their minimum obligations and other things. And so it's not just about understanding the rules around pensions and what the minimum requirements are. It's understanding that failing SIS and failing the requirements under the SIS Act mean you will fail the requirements under the Tax Act. And so whilst you might think you have a pension, if you don't meet the regulatory requirements of 106(9)(a), with regards to the annual drawdown, meeting the minimum obligation and the commutation rules, if you fail that, then you don't have what the tax office call an income stream. Right? And if you don't have an income stream, you don't have ECPI, and you just have a lot of lump sum withdrawals and a lot of administrative nightmares. And this is something that obviously the ATO updated, and I'll come back to this slide actually in a moment. I'll jump forward to this one. The ATO updated the TR 2013-5 ruling 2 years ago now, and effectively this year, the 25-26 year, is the first full gung-ho year of it, that if you get things wrong, that there's a problem for the fund. They gave you a little bit of leeway last year with regards to it. But if you don't meet that minimum obligation, the pension ceases for tax purposes back on the 1st of July of the preceding year. 30 June becomes the transfer balance cap event, right? Failing the minimum standards becomes the transfer balance cap event. And then you must make a conscious decision. If you ever want to get ECPI again, you've got to make that conscious decision to stop that income stream, roll back, and then recommence. And so, we can't highlight this point enough in how critical it is to pay that minimum, because I know through conversations I'm having with the SMSF Association, they're still fighting with the ATO to get a stated position on things like how to treat those payments throughout the year. So the ATO have said they're lump sums, but whether or not you actually have to go back and calculate the tax-free and taxable and all those sorts of elements, we still don't have definitive positions on that. Now, the key is with Payday Super and Div 296 coming in, we're not going to get a definitive position for a while. So how do you solve that? Pay the minimum.
Yeah.
Right? Ensure that you're paying the minimum. And certainly this, from an administrative point of view, this is clearly one of the big things that your team focuses on from a year in, year out
Yeah,
process.
there's a lot of, as we're going through the presentation today, there's so many areas that can easily go wrong and have significant consequences. This is one of them. And I imagine that would be stressful, and it sort of, I can't resist but say, if you've got SMSF accounts with a whole heap of different providers, and you're the one going to those providers working out what the minimum is, has the FY25 financials been finalised and the tax return lodged? Can we rely on this minimum figure? How much has been drawn to date? Are we checking back through bank statements to work out where we're at and what's our shortfall and how much extra do we need to take if it's still only an estimate, and all of the complexity and stress that comes with that is what we aim to take away. And so, this is something that we share for you in Hive. Is this a spot where we might be able to just flick across and give a bit of an example of where to find that, or do you want to finish off the previous slide that you got to first?
So let's just finish this pension piece first. And that is that, whilst we talk about pensions, June 1 June's an important date, obviously, because you can commence a pension and not have to pay your minimum for the financial year. So it's always a critical time, but it's also key to look at. And I think, transition to retirement income stream, not too dissimilar to the recontribution strategy, is one of those strategies that people should be contemplating. One, because it's not linked to the transfer balance cap, right? So it gives you that drawdown capacity. So from a fund rebalancing point of view, albeit 10%, it gives you that early access, legal early access to your super from age 60. Considering that, and looking at contribution strategies, where does TRIS and salary sacrifice sit for certain clients who, one, have access to carry forward concessional, two, have access to salary sacrifice arrangements and things. And so how can we offset personal tax, right, and still maintain our balance inside a super by making salary sacrifice and then drawing benefits down? So, there's still a lot to play out, and TRIS is critical to all that, noting that if you get your minimum maximum wrong in this sort of arrangement with a transition to retirement income stream, well, then you've accessed preserved monies.
Yeah.
We don't even want to fathom taking more than the maximum, right? But even underdrawing the minimum in a TRIS is problematic because it is an early release, and that means it's assessable income at marginal tax rate. And a breach of the legislation. Now, how hard the ATO go on that is a separate matter, but it's one to be mindful of there. And so when we contemplate all these things with regards to pensions, ensure that rule number one is meet your minimum, right? Meet your minimum. And then if you're drawing down additional benefits from that point, and this is prospective, this is not retrospective transactioning here. So this is almost a trigger for next year as much as it is for June, is any amounts over and above your minimum, how do you expect to treat them? Do you wish them to be treated as lump sum withdrawals from an accumulation interest? Do you wish for them to be treated just as pension payments? Or do you wish to free up some potential transfer balance cap space by taking them as partial commutations. Doesn't give you any higher personal transfer balance cap, just gives you cap space to put money back into pension if you need to in the future. And so that whole lump sum withdrawal piece is certainly something to be mindful of.
Yeah,
Yeah,
that's always, it's actually, it's a fear I have for members out there who might get sort of 10 years, although we're almost 10 years already down the track from
yeah,
transfer balance cap, or they might get 15 years down the track and find that they've got no transfer balance cap left
yeah, yeah,
and no money in the pension account, and all of a sudden they're paying 15% tax, but they've taken a whole heap of lump sum withdrawals during that process,
yeah,
or they've taken an excess of their minimum requirement during that process, more to the point, and not taken them as lump sums or um, commutations.
yeah,
All of a sudden, they've got nothing left in the tax free in the tax exempt portion of the fund, where they could have still had,
yeah,
a million, 1.5, $2 million of money that's tax free. And so I think people are going to get down down the track and then realize that a failure to make intelligent strategic decisions early on has landed them here.
yeah. I'm gonna so we wanted to jump into Hive
Yeah.
very briefly. So this is a test of my IT skills, Josh, and this could fail dismally, but we're going to give it a crack, and I'm going to see what happens if we try to find this screen here. So I'm going to see what we're sharing now, and I think I maybe need to go from there to here,
Yeah.
and I'm hoping that everybody can now see the screen in front of them as being the Hive screen.
Yeah.
And so, Josh, if you wanted to drive that for a couple of minutes just to show and to make some comment about that.
Yeah, so many of you will have seen Hive, I'm quite sure, especially if you've got clients with SuperGuardian. But I guess at this time of year, it's just a perfect opportunity to highlight some of these things. Minimum pensions, we're keeping this information up to date. So on the dashboard, you've got a quick summary. We have made some changes in the last couple of weeks around this, just to improve the detail that we provide here. So you can now see for any of your clients that have a pension. You can drill down to underlying pensions for each of the members. You get a quick snapshot of what the shortfall is. And if you wonder, I took a withdrawal yesterday, has that actually been processed and reconciled? Well, we do provide a date showing when it was last reconciled, which is typically either the end of May, which we would be have reconciled now, or to date, because we're reconciling more regularly during the month of June. You can click here and you can quickly have a look and see what payments have factored into the drawdowns. Again, you can see highlighted here whether or not it's an estimate or a final calculation, depending on whether or not the tax return has been lodged and finalised. And again, this is just demo data, but a really good way of seeing all that information in one place. And you can export it as a spreadsheet across all your customers to sort of use it as a tool to then communicate with clients around how much more they need to draw. Aside from this, so this is accessible to you when you log into Hive. Aside from this, there will be notifications that go out that you'll see that are like an actionable task, if you like, just to make sure that we're on top of them. They can be shared with the trustees themselves by just assigning that to the trustee to make sure they get the notification as well. Or you can sort of action and respond in line. If there's anything we need to highlight to you in that of any particular interest, then we'll throw some comments in there as well. But yeah, rest assured, we're keeping this information up to date as we go. It's there at your fingertips across all your clients. And we'll also make it, there in your inbox as well, to make sure that it's, we don't miss any of these.
Yep.
Interesting. and I'll resist the urge to go into too much more detail around what we've got here in Hive, but we do also have a minimum pension excess button. I'm not sure that there's no examples in this case, but that's worth having a look at when you get to the new year, and we again will engage with you around this to make sure that the plan for pension withdrawals or withdrawals, personal withdrawals for the year ahead is clarified in terms of the order, satisfying the minimum pension, taking from a lump sum from accumulation, partial commutations from the pension account, etc. So there's some really good strategic insights. And initial pension commencement is another one. So if you've got clients that are actually, could be eligible to commence a pension but have money in an accumulation account, we'll highlight that for you as well. So there's some great tools. I'll leave it at that for now for Hive and hand back to Tim.
All right, thank you, Josh. And oops, I don't know what I just pressed there, but that's always the trick of me and presentations. So, all right, so let's jump back into here and take us back to the presentation. Where am I going? Going to there. So, probably as we finish this up, a couple of real minor points to highlight for the end of the year. And so we know, for example, that that from a fund point of view, we need to be aware of our investment considerations. And for me, this is one that we bring up every year, and this information was released earlier this week. We knew it was coming, right? LRBA rates for our safe harbour rules, they're going right back to where they were 2 years ago. So this is an area that people need to be mindful of, particularly because a lot of LRBAs are coming towards the end of the term. And as I'll show you the upcoming webinar shortly, I've got a webinar coming up in probably 2 months' time for you all around sort of exiting LRBAs and some of the key considerations around limited recourse borrowing arrangements, because we're at that 16-year mark since the rules changed in 2010, which means we're, for a lot of them, getting towards that exit point in time. So we need to understand how the rules work. But, then there's other things, for those that hold crypto, and it's becoming more and more mainstream from an investment point of view, still not, hugely significant, but it's becoming more recognized and understand what you need from a reporting point and valuations, all key things which I touched on before. We talked about the ECPI piece, and it's important at this time of year just to understand when you can and can't use, say, the segregated approach. And one of my comments that I've highlighted there is that all first-year pensions can segregate, right? So you can always segregate in year one, because you always have to look back at the previous 30 June. And if there was no pension in place at the previous 30 June, then you've got the consideration to be able to segregate. And that can be important when it comes time to selling down assets of the fund. And of course, you have your standard approach where you would apply the deemed segregated periods and the unsegregated periods from an actuarial requirement, or you can just apply a choice approach and get the actuarial certificate on a proportionate basis throughout the entire year. So key things that at this time of year it's always important to understand when lodging a fund. So for me, Josh, the last thing, the last sort of key things before we wrap this up and summarize is that as we do our checklist of all the things we need to consider from what strategies are we implementing before 30 June, have we met our pension obligations, have we done all those things? We know we're under an obligation to review our funds investment strategy. We sign off on it every year that we've reviewed our funds investment strategy. But there's so many other things that we need to make sure, and we've touched on a few of them today, like the lump sum, whether you take a lump sum or a pension, have you got your notices done on time? But other things as well that come into it. Have you updated your storage documentation around your collectible and personal use assets? Again, right up there with crypto from a percentage of fund investments, but they still exist in that place. And from a compliance point, are you meeting all your definition requirements? I've seen so many court cases recently around disqualified people with SMSF trustees. So, is everyone satisfying the requirements? Is there anything that triggers somebody needing to be removed from the fund? Are you looking to add members to the fund? Do you have people overseas? Where do you sit in the definition of an Australian super fund? Do they want to contribute? All sorts of things that you have to take into consideration. So not just that, where's your deed? I'm not just saying this in light of the fact that DIB 296 is around the corner, but if super reform was a big event in 2016, 2017, we also had downsizer come in after that. We've had other things that have come in and people are utilising these strategies, but does their deed provide for it? And so we should always be reviewing our deed. We should always be reviewing our binding nominations in addition to our investment strategies. And similarly, and I think probably most importantly, is things like our enduring power of attorney, because you don't know when you're going to lose capacity, right? And that's the whole point of losing capacity, ultimately, in many respects. And so, have we got all those legal documents in place as well? All critical matters.
One of those things you don't know when you're going to, and you don't know when you have.
Correct, correct. So yeah, so look, it's been for me, it's a great opportunity once a year to sit down with yourself, Josh, and talk through some of these things with a admin slant on it. I can try, but you know as
You've
well
always
as
done a good
everyone.
job of that without me, I think, Tim.
But you've experienced as much as others that I've worked with before. Admin's not my strength. I know how to admin my own fund, but
No,
that very
you're too
limited.
humble about it, that's all.
And so there's all these sorts of key things to take on board. So look, that does bring us to the end. I just highlighted that I've got LRBAs coming up. I think it's time for us to revisit estate planning. It's always a popular subject matter, and so I'm going to do a bit of a refresh on death benefits and paying, or what happens when a member dies in our July webinar. Then I will turn back to that LRBA place because it's been a couple of years since I've done that for the broader group, and then I'll look at pensions coming up in that September presentation as well, which aligns with them doing one for the SMSF Association at their tech summit on pension rules, and so I think it's good to be able to bring that back to the masses as well. So always a pleasure having you join me, Josh, and I hope for those on board that you got something out of it.
Yeah, thanks very much, Tim. I think we've actually done quite well to only be 2 minutes over time. I
I
think
think we have,
that's
yeah.
pretty impressive. And thanks everyone for joining. If you've got any questions, by all means, don't hesitate to reach out to us or through our website or through your client manager. Be very happy to help.
And of course, a copy of the presentation will be sent out with the CPD. So keep your eye out on your inbox for that over the sort of coming 24 to 48 hours.
Thanks.
Terrific.
Thanks, everyone.
Cheers.